Welcome back to the deep dive. We love taking those financial questions that they look simple on the surface, but once you start peeling them back, you find just layer upon layer of complexity.
Hmm.
So we stack up the research, we look at all the data, and we try to give you that really granular detail you need to move forward with some confidence.
Yeah, to make an informed choice.
Exactly. And today, we are wrestling with a scenario that, frankly, is a great problem to have, but it absolutely brings its own significant anxiety.
It really does. It's the anxiety of the last mile, in a way.
That's a great way to put it. Our listener is 5 short years away from retirement, and they've achieved this monumental milestone of $1 million in their 401k. I mean, just stop and think about that. That is decades of incredibly disciplined saving finally paying off.
A huge accomplishment.
Yeah.
Absolutely huge.
But this success leads to the central and I think profound question. They currently hold a life insurance policy, one designed years ago to protect their spouse. Now that the nest egg is so substantial, $1 million strong, does that traditional safety net still justify the cost of the premiums?
Right. Is it redundant now?
Exactly. Should they cancel it to free up that capital? And, if they do, have they really ensured their spouse remains financially protected against everything?
That last part is the key. Against everything.
So our mission today, it isn't just about comparing the premium cost to the death benefit. That's too simple. We are conducting a really strategic deep dive into the specific financial ecosystem they've built.
Yeah.
Because this decision, it marks a profound shift in financial philosophy. You're moving past the aggressive chase for growth. You hit the $1 million target, right? And now the pivot is entirely toward strategic preservation, income reliability, and making sure every single dollar works to protect what you've earned.
That framing is exactly right. The timing is so critical here. Reaching that $1 million mark while retirement is just looming on the horizon.
Yeah.
That convergence, it just amplifies every single variable in this decision. $1 million is a fantastic headline figure, but for the purpose of securing a surviving spouse, it's just a starting point. It really is. We need to look under the hood and determine its real spendable worth and, I think most importantly, its capacity to generate sustainable long-term income.
So where do we start peeling this back?
I think before anyone even thinks about canceling a policy, we have to clearly analyze 3 pillars of security. First, we need to define the net, the usable value of that 401k, accounting for all the frictions and reductions.
Okay, so what you actually get to spend.
Exactly. Second, we have to stress test its projected income stream against the realities of inflation and required expenses. And third, we absolutely must identify any remaining high-impact, catastrophic financial risks that the life insurance was specifically purchased to mitigate in the first place. Only once we have clarity on the integrity of that $1 million asset across those 3 areas can we give our listener the confidence to make the final move.
All right, so let's start with the good news again. $1 million in a retirement account is a powerful achievement. It's the solid foundation of a comfortable retirement, and it signals incredible foresight and commitment.
No question. It's something to be really proud of.
However, we need to immediately address the massive difference between the nominal value, that big round $1 million figure, and the actual net spendable inheritance that the spouse would receive. This is the first hurdle, right?
It's the first and maybe the biggest.
And the most critical distinction here is the tax status. Is this a traditional pre-tax 401k or is it a Roth 401k?
That distinction is, it's non-negotiable. It changes everything. If that $1 million is sitting in a traditional 401k, it means that not a single penny of tax has been paid on it yet.
Right. The contributions were tax deductible on the way in.
Exactly. All those contributions were pre-tax, which means that when the money is eventually withdrawn, either by our listener or by the surviving spouse as the beneficiary, it's all treated as ordinary income.
And this is where the math gets a little bit chilling. If we look at the source material, a conservative illustration suggests that if the beneficiary spouse is pulling funds out and faces, let's say, an effective combined state and federal tax rate of 25%.
Which is not an unreasonable assumption at all.
Not at all. That immediately means $250,000 is gone, vanishes. You start with $1 million. But the net spendable amount is reduced immediately to $750,000.
Right out of the gate.
I mean, that is a substantial tax drag. It eats up a quarter of the entire intended inheritance. And that $250,000? Well, that might have been exactly the safety margin the listener was relying on to cover potential shortfalls or, big debts like a mortgage.
Precisely. That could be the entire mortgage gone to taxes. Now, contrast that reduction with the Roth 401k. Because those funds were contributed with after-tax dollars, the $1 million generally allows for qualified tax-free withdrawals for the beneficiary.
So a million means a million.
A million means a million. The spouse receives the entire amount. The difference here isn't subtle. It is quite literally hundreds of thousands of dollars. It completely recalibrates the baseline security level of the surviving spouse. So step one for our listener. You absolutely must confirm the tax status of that $1 million because it defines the scope of the entire problem.
Okay, but let's go a layer deeper here. Let's say the listener confirms it as a traditional 401k. It's all pre-tax. Does that mean it's a lost cause? I mean, the question then becomes, can we mitigate that future tax drag now in these 5 years leading up to retirement?
That's a highly actionable question, and the answer is yes, you can. If they've confirmed that a significant portion is pre-tax, they should immediately begin exploring small strategic Roth conversions over these next 5 years.
Okay, so how does that work?
Well, the goal isn't to convert the whole $1 million. That would be prohibitively expensive. It would spike their income into the highest tax brackets.
Right, a huge one-time tax bill.
Monster tax bill.
Yeah.
No, the idea is to convert strategic chunks. For example, you look at your current tax bracket, and you convert just enough each year to fill up that bracket without pushing yourself into the next higher one.
So you're paying tax at a rate you're already comfortable with.
Exactly. You're controlling the tax rate. Maybe it's $20,000 a year for 5 years. They pay the tax on $100,000 now, likely at a lower marginal rate than their spouse might face, pulling larger amounts out later in a panic. And then that $100,000 grows tax-free and can be withdrawn tax-free forever.
So it's a way to systematically shrink that future tax liability.
It turns a $250,000 problem into a manageable 5-year planning project.
Fair.
And this proactive step, I mean, this could be a much better use of available cash flow than paying for life insurance. It's really just there to cover a tax drag they could be eliminating themselves.
Okay, that makes a lot of sense. So let's shift focus now from taxes to the investments themselves. The allocation. You're 5 years out from retirement. This is a completely different game than being 20 or 30 years out.
Completely. The whole mindset has to change.
The focus changes from maximizing compounded returns to really just protecting the capital you've built.
And true.
And this requires a systematic approach.
It does. When you're 20 years from retirement, a major market dip, a 2008 style crash, is just a buying opportunity. You have time to recover. But 5 years out, a 20% drop in the market means you lose $200,000 of your capital.
And you don't have the time horizon to wait for it to come back.
You don't. You need that money soon. This means the ultimate enemy at this stage is volatility. So our listener needs to look at their portfolio and ask about their glide path.
A glide path. Can you define that for us?
A glide path is just the systematic de-risking of a portfolio as you get closer to your retirement date. Think of it like a plane coming in for a landing. You gradually reduce altitude and speed. You don't just cut the engines at 30,000 feet. So if they still have, say, 80% in high-growth equities, that allocation is likely overly aggressive. A massive loss could force the surviving spouse to sell during a downturn just to cover monthly expenses. And when you do that, you lock in permanent losses and decimate the capital base prematurely.
But the danger works both ways, right? What if you get too scared?
Absolutely. If the portfolio is overly conservative, say 80% in cash or high-quality, low-yield bonds, they risk insufficient growth to fight inflation over the long haul.
So your money is safe, but it's losing purchasing power every single year.
Exactly. You may be sacrificing that necessary 1 or 2% of real growth that keeps you ahead of rising costs. And that means the capital won't last the required 30 years for the surviving spouse. The balance 5 years out is just crucial.
So what's the actionable step?
The listener needs to review the specific holdings. Are they tied up in illiquid alternative assets? Are the fixed income components, the bonds, primarily short-term to mitigate interest rate risk? The goal must be maximum capital preservation with just enough growth to beat inflation. You want a portfolio that dips less than the overall market during a crisis.
Which gives the surviving spouse peace of mind.
Peace of mind, and, crucially, it allows her to draw income without selling assets at a loss. So, understanding the tax treatment and having a secure, de-risked allocation, those are the non-negotiable foundations for assessing the real net value and the safe liquidity available to the wife.
Okay, so once we've established the net value of the capital, what's left after taxes and what's protected from market swings, we move to its primary function, converting that lump sum into a reliable, sustainable income stream for the surviving spouse.
The queen of the money, really.
The foundational concept that almost everyone relies on, and what we need to use as our benchmark, is the 4% rule.
The 4% rule, a famous and maybe infamous rule in financial planning. For those who need a quick refresher, it suggests that you can safely withdraw 4% of your starting portfolio value in the first year of retirement. And then you adjust that dollar amount annually for inflation. If you do that, there's a statistically high probability of the funds lasting for 30 years. It's based on decades of market data famously synthesized in the Trinity study. It provides a useful, if often debated, starting point.
So let's run the basic numbers.
Yeah.
Using the full pre-tax $1 million nest egg, the 4% rule equates to a projected sustainable annual income of approximately $40,000 per year. That's our target benchmark.
$40,000 a year.
But here's where we need to challenge that assumption, as you just hinted. Given the current economic environment, we've had recent spikes in inflation. Bond yields have been historically low for a long time. Many financial planners are now modeling a safer withdrawal rate, something closer to 3.5%, maybe even 3%.
They are. The original study was based on historical returns that might not repeat. If we drop that withdrawal rate to 3.5% for an added margin of safety, the sustainable income from that $1 million drops to $35,000.
A $5,000 pay cut right there.
And if we're really conservative and drop it to 3%, we're looking at just $30,000. This is the conversation the listener needs to have with themselves. How much risk are we willing to take on the longevity of this account? But let's stick with the 4% rule for now, our $40,000 figure, and frame the central question. Is $40,000 a year sufficient for the wife's anticipated living expenses?
And we look at the hypothetical scenario from the sources. If the wife's estimated annual expenses for a comfortable life covering the mortgage, utilities, insurance, property taxes, food, maybe a little travel, are $60,000, then we immediately identify a substantial $20,000 annual shortfall.
And that shortfall, right there, that is the classic definition of the risk the life insurance was purchased to cover in the first place. That's its whole job.
Explain that.
Well, if the policy was set up to provide a lump sum, say $400,000, that lump sum, if it was invested very conservatively, could generate enough supplementary income to bridge that precise $20,000 gap for her remaining lifetime.
So the 401k provides the base income, and the life insurance proceeds provide the top-up.
Exactly. If they cancel the policy, they are effectively agreeing that the $1 million 401k must somehow cover that $20,000 shortfall every single year. And that means either taking a higher, much riskier withdrawal rate or forcing the wife to drastically cut her lifestyle expenses.
But the shortfall only addresses today's expenses, right? We have to introduce the silent killer of retirement security, which is inflation.
Yes, the invisible tax.
People understand inflation conceptually, but I think they often underestimate the constant insidious erosion of purchasing power over decades, that $40,000 is only real security today.
Let's use the detailed inflation example we have. Assuming a conservative average inflation rate of 3%. The effects are truly striking over a long period. In just 15 years, the purchasing power of that $40,000 shrinks dramatically to roughly $27,500.
Wow.
Think about that. 15 years into her retirement, the surviving spouse can only afford about 2/3 of the life she could afford on day one, even though the dollar amount being withdrawn has actually increased slightly because of the annual inflation adjustment.
And if she lives even longer, the picture becomes more precarious.
Much more. In 25 years, which is a very likely duration for a surviving spouse, that $40,000 income stream has the purchasing power of about $19,000 today. The income has effectively been halved.
So her standard of living gets cut in half over her retirement.
Potentially. If life insurance is canceled, that $1 million account must not only provide the income, but also maintain sufficient growth to combat this persistent erosion. If the market delivers only modest returns for a decade, the portfolio will fail much, much sooner than planned.
And this leads directly to the core long-term risk, longevity risk.
The risk of living too long. If the wife is younger or healthier than her husband, she could need financial support for 30 or even 35 years. The sources we looked at stress that longevity risk is the factor demanding the greatest flexibility in a portfolio.
And that's a strain on an already strained plan.
It is. If the $1 million is already stretched thin, covering an income gap, and inflation is guaranteed to diminish its purchasing power, the risk of prematurely exhausting the capital base just skyrockets.
Yep.
And that leaves the wife incredibly vulnerable in her late 80s or 90s.
We also have to layer in those secondary financial threats that compound this erosion. The most notorious one is healthcare. Healthcare cost increases have persistently and reliably outpaced general inflation for decades. So if general inflation is 3%, healthcare costs might be rising at 5% or 6% a year.
Or more. And this means the portion of her budget that's dedicated to health and wellness consumes an increasingly larger share of that diminishing income. If the life insurance safety net is removed, that million-dollar portfolio has to absorb the combined force of general inflation and these accelerated healthcare pressures without fail.
So the takeaway from this section seems really clear.
It is. The $1 million is not infinite. Its sustainability is extremely sensitive to the withdrawal rate, the inflation rate, and the longevity of the beneficiary. If they cancel that insurance, they have to be absolutely certain that the remaining assets can safely cover that $20,000 income gap and maintain purchasing power for the spouse's entire projected lifetime. And that is an enormous burden to place on one single asset.
So we've analyzed the long-term income gap, which is a slow burn, but let's transition to the immediate reality of a death, outstanding debt.
The bills that come due right away.
Right. Life insurance is fundamentally designed to provide immediate liquidity to prevent existing debts from becoming an instant crisis for the grieving survivor. So we need to list the primary outstanding liabilities. This typically includes mortgages, car loans, personal loans, credit card balances. These are obligations that don't pause for grief.
They absolutely don't. And the most significant liability in this context is almost always the mortgage. Let's stick with the source's illustrative debt example. A remaining $200,000 mortgage balance on the family home.
Okay.
Now, while the $1 million nest egg is theoretically sufficient to cover this, forcing the surviving spouse to liquidate $200,000 from the 401k immediately after a death presents a whole host of problems.
What kind of problems?
Well, first, there's the tax issue we already discussed. If it's a traditional 401k, that $200,000 withdrawal is taxable income. It could easily push the spouse into a higher tax bracket for that year and immediately consume a large chunk of her cash flow. So you might need to pull out, say, $250,000 just to have $200,000 left to pay the mortgage.
And you've just shrunk your retirement account by $250,000, not $200,000.
Exactly. And second, there's the market risk. What if the death occurs during a market downturn? The spouse is forced to sell assets at a loss just to cover the debt. That compromises the entire income-generating capacity of the remaining capital. It's a terrible situation.
Whereas the beauty of life insurance is that the payout is a tax-free lump sum.
Tax-free and immediate. It guarantees the surviving spouse housing security by extinguishing that $200,000 mortgage instantly without forcing her to compromise the long-term 401k income plan or worry about market timing.
So if the listener cancels the policy, they need an ironclad plan for how that $1 million after tax and without market risk will cover that mortgage instantly.
They do. But the risk assessment doesn't stop there. We have to look for less obvious but potentially devastating liabilities. We call them contingent liabilities.
What are those?
These are not debts the listener pays every month, but debts that become immediately due or active upon their death. They're sleeping giants, in a way.
Okay, give me some examples.
Co-signed loans are a prime example. Perhaps they co-signed a large student loan for a child, or they guaranteed a business line of credit for a side venture. These obligations might have been comfortably handled by the primary earner, but they suddenly fall fully onto the surviving spouse, often with a strict repayment schedule.
Wow, I hadn't even thought of that.
These hidden burdens can have a sudden, substantial financial impact, and they are exactly what a life insurance policy defends against. It's a cleanup fund for all the financial loose ends.
And now we have to return to what you called the monster in the closet, long-term care costs, LTC. We mentioned the rising costs, but the severity demands a deep dive, especially when we're evaluating that $1 million account's resilience.
It's the #1 risk that can derail an otherwise perfect retirement plan.
So let's talk specifics. You mentioned a nursing home could cost over $100,000 a year. If she requires 5 years of care, that's $500,000. How do we even begin to secure a $1 million account against a threat that large? And let's be clear about why Medicare doesn't really help here.
This is the crux of the issue, and there's so much confusion around it. Medicare covers skilled nursing care. That means rehabilitative care, usually short-term, that requires licensed medical professionals. Think physical therapy after a hip replacement.
Okay, so medical care.
Right. It does not cover custodial care. And custodial care is what most people need long-term. It's non-medical assistance with activities of daily living. Bathing, dressing, eating, mobility. This is what you get in nursing homes or assisted living facilities.
And Medicare pays zero for that.
Zero. And this is where the source material's alarming specific cost detail comes into play. The average annual cost of a private room in a nursing home now routinely exceeds $100,000. In some states, it's closer to $150,000. That's a $10,000 or $12,000 expense every single month.
That cost is a financial tsunami. If the surviving spouse requires just 5 years of this type of care, which is common for cognitive issues or mobility decline, that's $500,000 immediately consumed. That figure is so relentless and large that it is capable of decimating even $1 million nest egg rapidly. Especially if that nest egg is simultaneously being tapped for daily income, that $40,000 a year, and it's trying to fight off inflation.
It's a three-front war, and the portfolio is likely to lose. If the life insurance was sizable, it offered protection against this specific massive liability. It created a dedicated pool of tax-free money the moment it was needed. If that policy is canceled, the listener must consciously accept the full, unmitigated risk of a $100,000 a year LTC expense falling squarely on that $1 million investment portfolio.
So evaluating these high-cost contingencies is absolutely essential before you determine that the safety net is obsolete.
It might be the most important part of the evaluation.
This brings us to perhaps the most pivotal factor in the entire calculation, the wife's own financial situation. We have to emphasize that her financial independence, or lack thereof, is the ultimate barometer for whether this life insurance is still necessary.
It really is the tiebreaker. You can't make this decision in a vacuum.
So the listener has to conduct a really honest assessment of her key components of independence. Does she have her own current income? What is her future earning potential if she were, say, forced back into the workforce? And most importantly, what personal retirement savings, pensions, or other guaranteed income sources does she have that are completely separate from the listener's 401k?
And this creates a monumental difference in the risk assessment. Let's look at the contrast scenario provided in the sources.
Oh.
We're comparing a spouse who is entirely dependent on the primary earner's $1 million 401k. That is her only lifeline.
Right.
Versus a spouse who has her own substantial independent security. For example, a $500,000 retirement portfolio of her own and a guaranteed $30,000 annual pension from a former employer.
That's a completely different world.
A completely different world. In the first scenario, canceling the insurance is an act of extreme risk because that $1 million has to defend against everything. Taxes, inflation, debt, longevity risk, LTC. In the second scenario, the $1 million is supplementary. It's a nice to have, not a need to have. And the life insurance is probably redundant because the spouse already has a substantial, resilient income floor.
Her level of reliance dictates the risk tolerance for canceling the coverage.
Perfectly said. And mathematically, we also need to consider her age and health. If she's younger than the primary earner, the duration of financial need increases, which places exponential pressure on the sustainability of the assets. The goal of that $1 million now shifts from lasting 30 years to potentially lasting 40 years. And as we saw with inflation, that's incredibly difficult to achieve.
And there's another concept that we need to introduce here, one that's critical in couples' financial planning: the widow's penalty.
It's a real and often overlooked phenomenon. This isn't just about women generally having lower lifetime earnings, though that's part of it. It refers to the specific, measurable financial challenges women often face in widowhood due to the structure of joint benefits, especially Social Security.
Okay, break that down for us.
Specifically, when one spouse dies, the surviving spouse typically only receives the single largest Social Security benefit between the two of them. They don't get both.
Oh.
So if the listener was the higher earner, the household loses the second smaller Social Security check entirely. And that results in a sudden and significant reduction in guaranteed household cash flow. This loss compounds the pressure on the $1 million 401k to bridge that income gap.
So the penalty is a structural feature that underscores the need for proactive planning on her behalf to make up for that lost guaranteed income.
Exactly. The life insurance might have been implicitly filling that Social Security gap.
And let's not forget the necessity of mitigating those truly catastrophic risks. Life insurance policies are inherently built to cover the black swan events, the things you can't predict.
The unknowns.
Right. If the policy is canceled, that $1 million becomes the sole buffer against unpredictability. We're talking about an unexpected job loss for the wife in her 60s, which is difficult enough to recover from. We're talking about a major unexpected health crisis that exhausts deductibles.
Or the ultimate nightmare scenario, a severe market downturn like a 2008 event that happens right after the husband's death. This would force the wife to pull income from a heavily depressed portfolio, locking in devastating losses at the worst possible time.
So the synthesis here is what?
The synthesis is this, and the insurance requirement is defined not by the sheer size of the million-dollar asset, but by the specific quantifiable risks and dependencies that remain uncovered once we factor in all of the wife's independent resources. If the combined assets and income of both spouses adequately cover the income gap, the debt, and that catastrophic LTC risk, then the insurance has done its job.
And the conversation can shift.
It can shift to strategic reallocation. But if those risks still loom large, that $1 million isn't secure enough yet on its own.
Okay, so if, after that exhaustive stress test analysis, the listener determines the $1 million, coupled with the wife's independent resources, adequately covers all the gaps, all the debts, and those catastrophic risks.
A big if, but a possible one.
A big if. Then we flip the conversation entirely. The life insurance premium is now excess capital that can and should be redeployed strategically for, superior returns or more targeted risk management.
The money is freed up to do a better job.
Exactly. So let's look at the immediate mathematical benefit. If the annual premium for the policy is, conservatively, $2,000 a figure, many middle-aged individuals pay for significant coverage, redirecting that cash flow into a retirement or a taxable brokerage account over the remaining 5 years until retirement immediately adds $10,000 to the principal.
Plus any investment growth on top of that.
Right. That $10,000 now becomes part of the income-generating base rather than an expense that's covering a potentially redundant risk.
This is where we stop thinking generally and start thinking specifically about risk management. If the decision is to cancel the broad life insurance policy, we have to immediately pivot to introduce targeted insurance solutions. And we need to stress the immense superior value of long-term care, or LTC, insurance.
So using the money to solve a more specific problem.
A much more specific and much more likely high-cost problem. We established that LTC costs can exceed $100,000 per year. That scale of expense is so large, it often dwarfs the typical $200,000 or $300,000 life insurance death benefit. So the life insurance was never truly large enough to handle the LTC disaster anyway.
That's a really interesting point.
Addressing this targeted highest cost risk proactively with a dedicated LTC policy, paid for with the old life insurance premiums, is a far more strategic, superior use of that capital.
Okay, but there's a nuance here. Many people find standalone LTC policies to be too expensive or complicated. They're hard to get.
They can be. And this is where hybrid policies come in. These are life insurance policies that include a special rider that allows you to draw down the death benefit early to cover LTC costs while you're still alive.
So it's a 2-for-1 deal?
In a way, yes. So instead of canceling the policy entirely, the listener might look at converting the current policy into a smaller, cheaper, specialized hybrid policy. This strategy leverages the premium dollars to cover the #1 catastrophic risk LTC while still maintaining a smaller, efficient death benefit for liquidity to pay off small debts or final expenses.
Okay, that's a great option. What's another strategic alternative?
Exploring guaranteed income solutions, annuities. We spent a lot of time discussing the volatility risk of the 4% rule and the uncertainty of maintaining purchasing power. An annuity directly solves both of those problems.
How so?
It converts a portion of the retirement capital into a guaranteed lifetime income stream that is entirely insulated from market volatility. It's like buying a personal pension.
And the source material gives us a great concrete example of the impact here. It talks about purchasing an annuity that guarantees, say, $1,000 per month or $12,000 annually.
Right. And that $12,000 annually can be used to supplement the $40,000 portfolio income. Suddenly, the wife's total annual income is $52,000.
Which is much closer to that $60,000 expense target we identified earlier.
Much closer. And importantly, that $12,000 is guaranteed for life. It provides an essential, unshakable income floor, regardless of whether the stock market crashes tomorrow.
So what's the downside? Why doesn't everyone do this?
The trade-off with annuities is liquidity and complexity. Once you give the insurance company the lump sum, you generally can't get it back. And the contracts can have high fees. But the benefit is certainty. For a surviving spouse, The psychological benefit of having a guaranteed income floor that covers basic needs, it can't be overstated.
And it takes pressure off the rest of the portfolio.
It drastically reduces the pressure on the remaining 401k, allowing that portion to be invested slightly more conservatively, which further enhances its longevity.
Finally, we have to emphasize foundational preparation. The decision to cancel should be a catalyst for a full structural audit of their finances.
Financial checkup, yes.
The premiums saved should first be used to ensure the estate plan is robust, up-to-date, and reflects the new asset distribution strategy, making sure the spouse is the properly named beneficiary on everything.
Which is shocking how often it's overlooked.
And furthermore, establish a separate, easily accessible emergency fund for the wife, completely outside the 401k. 3 to 6 months of living expenses in cash. So what does this all mean for you, the listener? It means canceling life insurance isn't a step backward in security. It can be a step forward in sophistication. It allows you to create a more diversified and robust financial plan, provided those premium dollars are strategically redirected toward the highest remaining risks, whether that's dedicated LTC coverage or a guaranteed income stream. You replace a broad, general income replacement tool with highly targeted, effective disaster defense. #TASHAG outro. This deep dive has, I think, thoroughly demonstrated that deciding to cancel life insurance when you have a substantial asset base like a $1 million 401k and you're 5 years from retirement. It is less about simple math and far more about highly personalized, granular risk assessment.
It's all in the detail.
It is. You've built an incredible foundation, but we've seen how fragile it can be to external pressures. We've uncovered the critical variables you must confirm. You have to nail down the exact tax implications, that $250,000 swing between a traditional and a Roth account. You have to stress test the income needs, recognizing the vulnerability of that $40,000 projected income from the 4% rule against a potential $60,000 expense target. You have to account for all outstanding liabilities, like that persistent $200,000 mortgage that could force painful liquidations.
Right.
And finally, you have to be brutally honest about the wife's financial independence and her ability to absorb a catastrophic shock, like a market crash or a job loss.
The ultimate goal here is resilience. That $1 million in your 401k is a powerful tool, but its true effectiveness and your wife's ultimate security, it all hinges on its ability to manage 3 unrelenting external pressures simultaneously.
Okay.
There's the significant tax drag inherent in traditional accounts. There's the persistent erosion of purchasing power due to inflation that can have the income stream over 25 years. And critically, there's the ever-present specter of unexpected high-cost healthcare expenses.
It has to fight all 3 at once.
All 3. Security in retirement is no longer achieved solely by accumulating capital, but by protecting it through diversification. If the life insurance is no longer needed, your strategic move is to ensure that your 401k income is supplemented by guaranteed sources, like annuities, or protected by dedicated insurance against the largest single-threat long-term care.
You're replacing general risk coverage with highly specific disaster mitigation.
That's the move.
The transition to retirement requires proactive planning for the most significant unforeseen expenses in modern life. So here's the final thought. How can you ensure your robust savings are protected from that single life-altering cost of long-term care, which can easily exceed $100,000 annually? Is a wise reallocation of your life insurance premiums the most intelligent, efficient, and direct answer to securing your wife's future, regardless of what unexpected health crisis may occur? Think less about simply replacing lost income and more about building a fortress around the assets you already have.